You got that favorite song, you hope it never ends, you like hit rewind, you hit loop, and the song just plays over and over and again. It's sort of like the housing market right now. Everybody wants to just keep going, go higher, prices go higher, making more money. Real estate agents are just hitting that register. But, as you know, at some point, the music stops. In this video, I'm going to talk about where we've been, where we're at today, and the two scenarios that could play out sometime at the end of this year. All right, so this is the neighborhood next to my neighborhood. And I've been here since 2014. And what has happened is, since 2014, this neighborhood behind me sat completely empty, except for 3 homes, since 2008. All right? And then COVID hit, and mortgage rates dropped, and the Fed went to 0 on the Fed funds rate, and this neighborhood is now almost completely built out. I'm told this house will sell for probably between $700,000 and $800,000. Now, I believe it's already sold. That's the crazy part. And then this house, probably in the 6s, okay? Now, let me go back to my house. The one with the black car in front of it, I paid $265 for it in 2014. In 2012, the housing market started to recover. And all the way up through 2019, which we had an enormous banner year for the economy in the United States in 2019, the housing market recovered, and then the Fed started cutting rates. They said they wanted to keep the economy going. They thought it could go a whole lot further, get a lot stronger, and by lowering interest rates, they could fuel this growth. I don't totally agree with their statement. I think they knew something. Because when you go back and you look at the German Bund, the 10-year German Bund, what you'll notice is it started its way into negative interest rate territory, where it eventually got to, I believe, in May of 2019. I believe the world knew something was a brew, and the Fed, well, their excuse was, we just want to put more gasoline on the fire. But then we got a hint of, a sickness, a virus. It was coming out of China, and that was COVID-19. Well, that hit the news starting October, November, December of 2019. The U.S. sort of blew it off. We didn't really take the moves that a lot of the rest of the world were taking. And as we got into the first of 2020, the COVID cases started to show up in the United States. I first remember the first cases coming out of a long-term care facility in Washington State, and then of course New York, since it's one of the biggest areas where international travel comes out of. Then the case count just exploded. The United States was entering a pandemic with the rest of the world, and eventually the Trump administration decided to say, you know what, we need to shut this thing down. Everybody needs to stay home, and we all did. And markets fell apart, and people started going, well, how am I going to pay my mortgage? And the Fed stepped in and dropped Fed funds rate to 0, basically. 0, meaning money is dirt cheap, meaning you can go out and borrow money so cheap, cheaper than you ever had a chance to back during the financial crisis or prior to the big housing boom. Well, people saw opportunity in this for cheap money. Interest rates on mortgage rates went down below, in some cases, below 3%. I mean, if you had a good credit score in mid-2020, you could pick up, a 30-year mortgage under 3%. I mean, I remember sitting with a friend, and he was in 79, bought his first house, and his mortgage interest rate was like 15%, and the mortgage lender said, it'll never get any lower than this. Well, imagine where we are today, back into 2020, when mortgage rates went below 3%. What did people do? Well, they started buying a home. This fall in mortgage interest rates spurred on one of the biggest housing booms we've seen, even possibly bigger than what it was back in early 2000s, and what it caused was the very financial crisis. For some reason, I don't think we learned from our past experiences. We often repeat them over and over again. And I believe we're doing that again. So where are we today? Well, number one, supply for homes is very small. Here on the Panhandle, if you want to get a new home or buy into one of the bigger neighborhoods in the area, you're looking at anywhere between 9 and 12 months before you can move into your new home. And the reason is because there's so much demand, there's little supply, and to get materials, it's hard to do. Lumber prices have gone up 4.5 times since the lows of March of 2020. 4.5 times. Meaning if I went to get a 2x4 at Home Depot a year ago in March, I paid $2. That 2x4 today, well, that's what, $8.50, $9 for that 2x4? Well, translate that into the cost of building a home. And now you're seeing the housing prices just skyrocket. Like I showed you earlier, my house in 2015, I paid $265 for it. Today they're telling me I can get close to $600,000 because there are no homes like my home in my area. And the whole nation is experiencing this same thing. So where are we headed? Well, here's my take. What I believe is going to start happening is you're going to see people start entering the labor force again. But what's going to really be the game changer? Well, we're going to go left or right, and it's going to come right around September or October. The left side is the inflation numbers come out, and they're right in line with where the Fed says they will be. That there is no inflation. That inflation it's in control, under control, and we'll see them not raise rates. And we'll see housing continue to grow, maybe not at the rate it's growing now, not at this 20% growth rate we saw in the first quarter of 2021, but we'll see it continue to grow. And mortgage rates will be sort of normal, maybe a little higher than they are today, but they will be normalized. And we'll continue to do this for a while. How long is a while? I have no idea. The other thing that will happen is that supply will catch up with demand, and the housing market will normalize and get back to where it usually is, as we saw in the later half between 2012 and 2019. Mortgage rates will stabilize, they'll normalize. The mortgage lenders won't make the millions they were making last year, but they'll make a good living. Then there's scenario 2. And I'm sort of leaning towards this scenario, and that is the inflation numbers will come out and they'll be bigger than expected, like a lot bigger. I look at the cost of goods today, the fact that if I went and bought a 2x4 today, it will cost me $9, between $8 and $9, depending on where you live in the country, compared to a year ago is right around $2 or $3. The cost of milk, the cost of goods, the lack of supplies, the increase in demands will cause the inflation rates to be higher than what the Fed expects. And they will be forced into raising the Fed funds rate, which, well, that basically kills the growth of the economy. And in particular, it kills the housing market. So the question you ask yourself, I assume, is if the Fed raises interest rates, how bad will that hurt the housing market? Well, the rule is 10 times rule. And basically what it means is that if the Fed raises Fed funds rate by 1%, that the housing values will drop by 10%. So let's say they don't raise them 1%, which is more than likely what they will do. They'll raise them a quarter point or a half a point. So for easy math, let's say they raise them a half a point. So 0.5% or 50 bips. Well, that would mean your house, in general, on average, would lose 5% of its value, which you could probably live with if if your house has gone up 20% or 30% or even doubled in the last 5 years or so? What if they lower interest rates? Well, they essentially can't because they're at zero. But theoretically, if they could, and they lowered interest rates by 0.5%, 50 basis points, well, then that means your house would go up in value 5% or so. You see how it works? It's a teeter-totter. So these are your two scenarios. Scenario one, the inflation is normal. It's in line with where the Fed thought it would be. They do nothing. They don't raise interest rates for many, 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 many years, as they said early on in 2020. And housing continues to grow, maybe not at this 20% clip, but more of a normal rate, maybe like 7 to 10%, maybe at the most 15. And then there's scenario two. Inflation is really out of whack. It's higher than they expected, and we see them have to raise rates. And let's say they move them at 1/4 point the first quarter, and then the second quarter they raise them, another 1/4 point. And in the end, they end up raising them 100 basis points or 1% total. That means your house in general, the value of it, and the housing market in general, will most likely drop anywhere between 2.5% upwards of 10%, depending on how fast they raise rates. Here's the other side of it is leverage. There's an enormous amount of leverage, higher amount of leverage in the world right now than ever before. Corporations are well over the $12 trillion mark in leverage, meaning they've borrowed money because it's so darn cheap. And if you get a Fed who comes out and says, you know what, we said we weren't going to raise rates for 2 or 3 years, and they raise rates, what does the market do typically? Knee-jerk reaction, right? You get kicked in the knee, what happens? Your foot flies forward, right? It's a reaction, and you have a sell-off of some level. So the question is, if one or the other happens, how do you play it? Back in 2010 when we moved to Florida, we up and left Birmingham. It was just after the big oil spill down here on the Panhandle. My wife and I saw this house. It was up for sale. It was selling for, it was just after the housing crash, and I believe it was selling for, $500,400,000. Unfortunately, we were carrying a home in Birmingham and paying rent for a home here on the Panhandle of Florida. Today, that home, well, that's about $3.5 million. Inflation, cost of goods. It just is. All right, so you know the two scenarios. How do you play the two scenarios? Number one, track inflation. Look at what true inflation is. Look at the cost of goods. Number two, track the commodity market, in particular copper and lumber. These are two big indicators to tell you what demand looks like when it comes to housing. If scenario one happens, which it could, interest rates or inflation could be normal, well, you sort of still in the same sector that we're in now, rising growth, rising inflation, and hawkish monetary policy. So chances are interest rates will stay low, which means money will be cheap, and we'll continue to see growth, but we'll also see the continuation of the cost of goods. So where do you go with that? Well, commodities, financials, along with maybe builders. Maybe they're not totally tapped out yet. Maybe there's more to go in the builder area. Do your due diligence. This is not advice. But what if scenario two is what plays out? We have a high inflation number. The Fed has to go back on his word, and he has to start raising rates. We see a 1/4 point or a 1/2 point move within the next 3 or so months after the inflation number after third quarter comes out. Well, here's how I'll play it. Here's my thought, and this is not advice, merely an idea, merely educational. So do your own work, do your own due diligence. Where I'll go is, I'll go to fixed income. I'll load up on treasury bills, treasury bonds in particular, probably the 10-year and the 30-year. I could probably get a lot more movement out of those two. I see those going up. I'll probably own the US dollar because the rise of interest rates, people will start gobbling up dollars again. Along with utilities, I'll look at adding those to my portfolio. And I will then take some short positions. Short positions meaning I'm selling a stock that I don't own to later buy it back at a lower price and return it back to the person I loaned it or borrowed it from. And so I will probably take a look at shorting. If it's not outright shorting the stock, buying puts on financials, commodities, things that have been working for the last, year or so. I'll actually go short against those positions. And can I use the long positions more in the fixed income positions, along with gold, US dollars, utilities, things like that. That's how I'll probably play it. But we are all have our own individual risk tolerances, and we have to respect those. We need to do our homework and do our due diligence. So this is information for you. This is how I see it. So you go do your homework, you do your due diligence, and if you would, share your ideas and your thoughts in the comments. I'm curious to see what you think, because together we can put together a good idea and possibly all capitalize it in the future. In the meantime, enjoy your summer as summer starts here very soon, I guess Memorial Day weekend, and have a great time, be safe, and of course, always live loud.